A few days ago I put out a video challenging the recommendations of financial experts to keep the portion of gold as a percentage of your overall wealth to 20% or less. I had some fun using some of the standard tools of modern portfolio theory and some actual historical data from the past century to show that even modern finance should be recommending a gold position of between 40 to 60%. I have to state for the record right now that I don't personally believe in the efficient market hypothesis, and so my personal opinion is that the allocation of gold should be much higher than what the tools accepted by modern finance would suggest. But I did find it very interesting that the tools used by modern-day experts pointed towards as high a gold allocation as they did. Since I put that video out, I've received numerous requests to see how silver would fare using the same analytic tools. So I dug up some historical data for London fixes going back to 1927 and added silver to my charts. So in this presentation, I will provide the charts that include both gold and silver as the store of wealth portion of the portfolio. Now, I'm not going to rehash how I constructed the charts here, so if you haven't watched my video titled Gold Allocation, please find that video and watch it now before going any further in this video. So with that said, let's see how the charts look with silver added to them. We'll start with short-term risk versus reward trade-offs. By short, I mean 5-year time horizons. On the horizontal axis, I'm using as a risk measure the worst 5-year performance for a particular asset or mix of assets over the past century. I've chosen this risk measure because it's losses that we really care about, not volatility. So the further to the left we go on the graph, the more risky an asset or a mix of assets has historically been. The further to the right we go, the better the asset class or a mix of assets has been in safely preserving purchasing power. So someone who is interested primarily in saving would favor points as far to the right as possible. On the vertical axis, I'm showing the historic average nominal yearly increase in the price of an asset or blend of assets. Don't mistake this for an increase in wealth. All it represents is an increase in dollars. So you'll have to adjust the numbers for the average rate of the decline in the dollar's purchasing power. I should also note that these statistics are historic in nature. They only tell us what's happened, not what's going to happen. And that's really the beef that I have with efficient market hypothesis. I personally think that the relative value of all of these assets can be assessed and used to improve returns. On this chart, I show as a blue curve mixes of stocks and short-term treasury bonds. The green curve represents mixes of stocks and gold. The black curve represents mixes of stocks and silver. We can see that over the short term, investors who are primarily interested in preserving their purchasing power have been best served by keeping most of their wealth in short-term treasuries. However, as the stock portion of the portfolio increased, the investor would have been better off from a risk and reward standpoint switching to gold. But what's interesting is that the portfolio mix typically recommended for retirees and pension funds, namely a 50-50 mix of stocks and bonds, was actually beaten on a risk and reward standpoint by a 60% gold and 40% stock portfolio. Now, how did silver fare here? Not really too well. But that's to be expected. Silver is much more volatile than gold, and so it's natural to expect that replacing gold with silver would shift the curve to the left. And it did. There really are no points on the gold and stock curve where a substitution of silver for gold made any improvement. But again, this is only for 5-year holding periods, which I consider to be fairly short. How did the presence of silver change things over longer time horizons? Things are a little more interesting here for the silver investor. We can see that over 10-year time horizons, mixes of stocks and silver perform better on a risk and reward standpoint than most of the stock and bond allocations recommended by the financial industry for pre-retirement investors. Most of the time we hear financial experts recommending limiting bond exposure to 40% and having 60% or more invested in stocks for growth. They state that so long as an investor can withstand the volatility, this is really in his or her best interest. But take a look at the black curve relative to the blue curve for all stock and bond mixes where bonds are less than 40%. For example, find the point that's labeled 40% on the blue curve. That's the 60% stock, 40% bond point. This is the expected risk and reward for a person who buys a conservative growth mutual fund. If that same investor held 40% silver instead of 40% short-term treasuries, the point moves up and to the right. In other words, the average return of the portfolio goes up, and the risk of the portfolio goes down. This is what those in modern portfolio theory would call a wise move. But again, when we compare silver and stock mixes to gold and stock mixes, we find that gold serves the investor better as the bedrock of the portfolio than silver. That's okay though. Financial experts don't really recommend either metal for their possible role in a balanced portfolio of assets. Let's see how gold and silver compare over longer holding periods. What we find when we looked at extended time horizons is that silver loses its advantage relative to both gold and short-term treasuries. Once again, I'll remind the viewer that this is only historic data and not a predictive tool. It only tells us what has happened and not what will happen in the future. While we can see that anywhere from 20 to 60% gold gave a portfolio a better risk and reward profile, the same can't be said for silver. 20% silver performed better than 20% short-term treasuries, but anything over that amount started quickly moving the black curve to the left. Silver has been very volatile over 20-year time periods in terms of performance. Now, I'll leave it up to you to interpret this information as you like. I'm not trying to pass judgment on silver as a bad investment. In fact, I've said many times in the past that I own quite a bit of it myself. Silver has the potential to increase a person's wealth because of its valuation, but valuation is not something that the tools of modern portfolio theory take into account. But since I had so many questions about how silver would look on these charts, I added it. So don't shoot the messenger. Please feel free to comment and discuss. I had some good discussions on the previous video, and so I'm sure we'll have some here. Thanks for watching.